The average American car payment just hit $767 a month, all-time high. And here's the part that should make you stop scrolling. Nearly 1 in 3 people trading in their car right now owes more on it than it's actually worth. They are paying for something that, financially, no longer exists. Not bad luck, math. Specifically, math that the auto industry has spent decades optimizing against you. And once you see exactly how the numbers work, you cannot unsee it. Let's get into it. Total U.S. auto loan debt right now sits at $1.6 trillion. That number passed student loan debt territory and it keeps climbing. The average new car loan is $43,582. The average new car price hit $50,326 in 2025. And with new auto tariffs pushing prices higher in 2026, that number is only going in one direction, up. Now here's where it gets uncomfortable. Most people buying cars today are not paying cash. They're financing at an average interest rate of 6.37% on new cars and 11.26% on used. And they're stretching those loans out longer than ever before to make the monthly payment feel manageable. That's the trap. The exact trap. Because the monthly payment is not the cost of the car, it is the minimum cost of borrowing the car. Those are two completely different things, and the industry knows that most buyers never run the second calculation. So let's run it for them. Take a $35,000 new car, finance it at 7% APR. At 60 months, you're paying roughly $594 a month and your total out-of-pocket lands at about $35,640. That's $640 in interest. Not bad. Now stretch it to 72 months to drop the payment. Your monthly falls to $533, which feels like a win. But your total just jumped to $38,376 in interest on a $35,000 car. Now go to 84 months. Monthly payment drops to $467. Feels even more affordable. Total cost, $39,228. You see what's happening? Every time you stretch the term, the payment falls but the total cost climbs. The dealer sells you on the monthly number. The actual bill is the total number. Nobody puts the total number on the sticker. Now run it on the average buyer. The average new car loan in Q4 2025 was $43,582 at roughly 7.1% for 72 months. That's about $665 a month and a total repayment of $47,880. You financed $43,582 and wrote checks totaling $47,880. That extra $4,298 bought you nothing. No extra miles. No extra features. Nothing. Just the privilege of not paying cash. Want the number that really stings? Run it on a used car buyer. Average used loan, $27,528 at 11.26%, because used car rates run nearly double new car rates, over 72 months. Monthly payment sits around $519. Sounds reasonable. Total paid, $37,368. Interest alone, $9,840. On a $27,528 car, that is 35% more than the car costs, just in interest. You're essentially buying the car and then buying 35% of it again, handing that money straight to a lender. And that's before the car starts losing value. Most people skip over depreciation because it sounds abstract. It isn't. The second you drive a new car off the lot, it sheds roughly 10% of its value. Not over a year, immediately, day one. In the first 12 months, most new cars lose 20 to 25% of their value. Some models drop 30%. By year 3, you can be looking at 60% of the original value gone. AAA puts average depreciation at $4,334 per year on a new vehicle. That is the single largest cost of owning a car, bigger than insurance, bigger than fuel, bigger than maintenance, and it never shows up in the monthly payment. Here's the concrete version. You buy a $43,000 car. You put $2,000 down and finance $41,000 over 84 months at 7%. At the 12-month mark, you've made payments but your loan balance still sits around $36,000. And the car? Worth about $32,000. You owe $4,000 more than the car is worth. Already underwater, after 1 year of payments. And the gap keeps widening for the next several years as depreciation outpaces your payoff rate. That is not a fringe scenario. That is the average purchase. 29.3% of all trade-ins in Q4 2025 carried negative equity, according to Edmunds. The average shortfall on those trades was $7,214, an all-time high, and 27% of those underwater trades were carrying more than $10,000 in negative equity. Also a record. By March 2026, J.D. Power had that figure at 30.5%. Nearly 1 in 3 car buyers walking into a dealership right now is still paying for their last car. And what does the dealership do with that negative equity? They roll it into the new loan. So now you're financing $43,000 in new car plus $7,000 you still owe on the old one, $50,000 total, on a car that starts depreciating the moment you leave the lot. The hole just got deeper. The payment just got bigger. 3 years into a 7-year loan, it is completely normal to owe $25,000 on a car that's worth $18,000. That is a $7,000 gap. Lose your job, need to sell, get in an accident where insurance pays actual cash value. You're short $7,000 with no car to show for it. Now let's talk about the 84-month loan, because this deserves its own moment. In 2019, about 13.4% of new car buyers were choosing 84-month financing. By Q1 2025, that was 19.8%. By Q4 2025, it crossed 20.8%. 1 in 5 new car buyers is signing up for a 7-year loan. Some lenders are now pushing 96-month loans. 100-month loans exist. That is over 8 years of payments on a depreciating asset. Here's the math problem nobody talks about with these ultra-long loans. Most new car warranties expire at 36,000 miles or 3 years. An 84-month loan means at least 4 full years of simultaneous loan payments and out-of-pocket repair bills. You're cutting a $467 monthly check on a car that's no longer under warranty and starting to need work. And because longer loan terms typically carry higher APRs at most lenders, you're paying a higher interest rate on top of more months. It compounds, not in your favor. Let's talk about what happens inside the dealership, because that's where a lot of the damage gets locked in. There's a sales tactic called the 4 square. The dealer draws 4 boxes on a piece of paper: purchase price, trade-in value, down payment, and monthly payment. They negotiate all 4 boxes at once. You think you're negotiating the price of the car, you're not. You're watching a monthly number while the other 3 boxes shift around to make the math work for them. Drop the price in one box? They adjust the trade-in value or stretch the term in the payment box. You walk out feeling like you won. The total cost went up. You just couldn't see it because you were watching 4 things at once. Here's a specific number on how much that costs. Say the bank approves you at 8.87% APR. The dealer has discretion to mark that rate up. It's called dealer reserve, and presents you at 11.37%. That 2.5% difference over 72 months shifts your total interest from $16,284 to $21,650. The dealer pockets a cut of that spread. You paid $5,366 extra and never saw a line item for it. Then come the add-ons. Extended warranty, just $59 more per month. Paint protection, gap insurance bundled in at a marked-up price. Each one sounds like almost nothing against a $650 monthly payment. Combined, they can add $100 to $200 a month. Over 84 months, that's $8,400 to $16,800 in additions you agreed to because the framing made each one feel invisible. None of that is accidental. Dealerships run training on this. The monthly payment is the anchor. Once you're anchored to a number, every add-on gets measured against that anchor, not against its actual standalone cost. Now step back from the car entirely for a second, because there's a number here that should genuinely shift how you think about this. Take $600 a month, less than the average car payment, and invest it at a 10% average annual return. After 5 years, you have roughly $46,300. After 10 years, about $122,000. Run it on the actual average payment of $767 a month invested for 5 years at 10%, approximately $59,000. More than the financed car is likely worth at year 5. You built wealth instead of debt, and you don't owe anybody anything. That's the opportunity cost of the car loan. The sticker price is what you see. The opportunity cost is the wealth you didn't build because the money went somewhere else, and nobody at the dealership mentions it. Now let's run the full true cost of ownership, because even people who understand interest often miss this one. AAA's 2025 data puts the total annual cost of owning a new car at $11,577 per year. That's $965 a month, not $767. The gap between what people think they're paying and what they're actually paying is $198 a month. Where does that gap come from? Depreciation, $4,334 a year. Fuel, about $1,950. Insurance, $1,694 on average. Maintenance and tires, $1,656. Finance charges, $1,131. Registration fees, $813. Added up, and the $767 monthly payment people are proud of negotiating is actually the smallest piece of the picture. So what do you do with all of this? First, the 20410 rule. Simple. Put at least 20% down. Finance for no longer than 4 years. Keep your total car expenses, payment, insurance, fuel, everything, under 10% of your gross monthly income. Most people buying cars today break at least 2 of those 3. If you can't hit all 3, you're buying too much car. Second, the certified pre-owned play. CPO vehicles skip the steepest drop of the depreciation curve. You're buying a car that's typically under 5 to 6 years old, with under 60,000 to 80,000 miles, backed by a manufacturer inspection and an extended warranty. Someone else absorbed the 25% year one hit. You're buying in at the flatter part of the value curve. Not exciting. Objectively smarter. Third, used with cash if you can pull it off. You cut out interest entirely. On a typical used car loan, that's close to $5,000 in interest payments that simply don't happen. No lender, no rate negotiation, no gap insurance pitch. You own it. Done. Fourth, and this one is underrated, keep your paid-off car. A paid-off car runs you roughly $200 a month in maintenance on average. A new car payment averages $767. The difference is $567 a month. That's $6,804 a year that either stays in your pocket or gets invested. Over 5 years at 10% returns, that's nearly $44,000. The boring, paid-off car with 80,000 miles on it is not a financial failure. For a lot of people, it's one of the smartest financial moves they're making. One more thing worth flagging for 2026 specifically. New import tariffs are already pushing new car prices higher this year. Analysts expect average transaction prices to keep climbing. That widens the spread between new and used even further right now, and it makes the case for CPO and used vehicles more compelling than it's been in years. If you're in the market, timing actually favors used more than it has in a while. Here's what all of this adds up to. The car industry is not selling you a car, it is selling you a monthly payment. That monthly payment is engineered to feel affordable while the total cost, the depreciation, the interest, the add-ons, and the opportunity cost quietly pile up behind the scenes. $767 a month on paper, $965 a month in reality, an asset losing value every single day you hold it. The people who build real wealth don't necessarily earn more. They just refuse to let a number on a contract substitute for the total picture. So tell me in the comments, are you currently underwater on a car loan, or have you managed to stay ahead of the depreciation curve? I'm genuinely curious how many people watching this are sitting on negative equity right now and didn't even realize it until this video. If this broke down something you'd never seen laid out this clearly, hit the like button and share it with someone who's about to walk into a dealership. This math could save them thousands. And subscribe if you're not already, because next week we're getting into the credit card debt spiral that runs on the exact same psychological playbook as this, and the numbers are just as ugly.